Yeah, what's up guys? I just want to make this quick vid about this new strategy I got for GEX. Basically gamma exposure delta hedging. I mean, people around me already know what I'm talking about, but just want to show a few clips of what I'm actually talking about and how the juice is actually pressed. Bad joke. But yeah, just look at this, all right? So, we got a few stocks I've been tracking. So, a lab, okay. I'll really make this quick. Just a little recording for myself and my associates. So look at this. Open interest is basically updated at the market open of the day. So it was last updated at 9:45 today. So it's not real time, but it's what we had this morning. And as you can see, what we had this morning is this huge call wall at $180. So meaning that if price goes over $180, that amount right there is basically what? So 5.8 million. This is for every percent move of the underlying stock. The guy behind this trade is gonna have to buy 5.8 million to be delta neutral. So all of this theory is related to option hedging flow. Okay, so this, I don't know if you're coming across this video by luck or whatever. Anyways, so if I look at the JAX by volume, barely changed because okay, JAX by volume is not at 945, but it's at updated constantly with the clearing house of the option clearing house. I think it's OCC or Oprah. I think they link it here on the website. Anyways, not that important. But you can see how basically checks by volume in real time. There is another small now put wall at 177.5. I didn't even check the price live, but yeah, we're over it. And if you go back to my other videos, I use Elliott Wave and um, Fibonacci analysis, and I'm still waiting before shorting this because we're in the third wave, zero, one, two, third, fourth wave. Basically, we're waiting for the fourth wave to go up because, in my opinion, after this week's expiry, which is not going to go below 177.5 to maximize their delta exposure, we're going to go back up after. And obviously, we're going to stay under 180, or else it'll cost 2.2 billion to hedge every percent move. So 181 dollar, that's 2 billion right there. $182, that's 4 billion. 190, that's 22 billion dollars of um, underlying hedging. So you'd have to buy 22 billion dollars of ALAB, which I don't know if you want to buy in this market top, but that's another subject. Anyways, I'm looking at delta exposure, which is basically the um, integral of gamma exposure. So change of option price in relation with change in underlying price, and this is change in delta with underlying price, with option price. Sorry. So delta exposure is a bit more telling in a sense where you have more varied, more spread out um, profit speed exposure indicator, if I had to put it in my own terms. Because since you are one integral under, you are basically um, calculating the uh, speed levels of your car. Okay, so imagine your car is in a two-dimension. Look, just I'm explaining as well to I never had to explain it, but if I had to explain it just to understand myself. You're in a car and delta is basically just giving you the direction. So I keep it to two dimension. So basically your car, your delta is telling you if you're moving forward or backward, okay? And your gamma, so your gex, your second order derivative is basically telling you the amplitude of this move, so the acceleration of this move. So that's why delta exposure is a lot more linearly distributed, is because, how can I say, the nearest exposure is not necessarily, how can I explain that? Well, if we imagine it in terms of acceleration, obviously acceleration is only going to be impactful in the beginning of the acceleration process. So, um, maintaining a, oh man, I don't know, I really have a bad explanation. So I won't explain it, but basically imagine this second order derivatives of this, basically the acceleration. So you won't have acceleration indication over all strikes because obviously beginning acceleration, so the one nearest to the current price, is what's going to determine future acceleration in a sense. Okay, don't quote me on that, but I'm just here to show you my fresh little indicators. Anyways, look, I'm going to do a live analysis right now since this is expiry day. Okay, this is Friday, and next week we got a little expiry. By the way, September 19 is uncoupling of a lot of options in the market. So big expiration date. I guess it's the end of Q3. So a lot of firms and everything are have their option strategies expiring end of quarter for the books and whatever. Look, I'll put next week's option exposure and check a bit with you guys how easily this is done if it actually works. So you can see already, wow, this guy is not kidding. This guy bought some extremely out of the money puts to try to ride that gamma wave with the IV spike. Well, IV is already kind of high. Why is that? I think because the guy bought a shit ton. 800. Wow. Only one was traded today. When was that? August 6th? That was a while ago. And what's the price of it? Option price hasn't moved. You know, I'm really bad with out of the money options. I have no idea how quick they move or anyways, really interesting position for this guy. I mean, I'm rooting for him. Just hope he's on my side and not gonna get licked. Not gonna get fucking destroyed by the option writers. Anyways, let's go back to, oh, is he in this? What was it? What was this thing? So this is 05 for strike 60. Where's the strike 60? Do we have it? Oh, it's right here. That's the guy, right? Or okay. Yeah, that's the single volume we saw earlier. I don't know what this guy's doing. Alright, I'm getting distracted. So, yeah, you see, next week's is open interest. Looks like we're just gonna set a range because there's a lot of put exposure and call exposure quite far from the current price. So might see, you know, like this is why other indicators like charm are quite important to see the degradation of these position over time. Because as you know, options are tri-dimensional. Yeah, tri-dimensional because they aren't just impacted by price, they're impacted by time or volatility. No, I would say time because there's the theta decay. Anyways, Look, I'm checking the JEX by volume, so this is upon live exposure, and I mean downside does look pretty juicy. IMO, see like 195 is a lot of exposure there. Yeah, these guys are rooting for a lab. I don't think they're gonna get their lab. Haha. Anyways, so DAX, just as I said, first order derivative, so a lot less um, near term influence in its indication. Okay, so you can see that, for example, this bottom strikes a lot of calls right there. Is it calls? What is it? 125. And there's positive. What's going on there? That's weird. I don't know why there's so much delta. Is it cause... Why is the delta so high? Can I click it? That's weird. Delta is near 1. That's weird. This might be a discrepancy from the website. So I'll take the volume one. Honestly, the OI is pretty glitched sometimes, but it's really good to know the pulse before and after. So it's good to have it. Yeah, so as you can see, delta and gex for the volume are pretty much the same because they're giving the direction bias, either long or short, or either positive or negative exposure, basically. Anyways, look, I don't know how much I'm rambling, but I'm gonna go on to my last two show and tell. SMP is a bad boy. So yesterday there was a huge gamma wall at around 6505. Okay, flat on 0DTE options expiring the 28th. And guess what? Price jumped right over it before crashing down. So those guys having puts or I don't know shorting calls at 6505 were literally saved by the last minutes. So you can see here 508 was at 55, and during the last 5 minutes it dropped, or the last 10, no, 5 minutes, yeah. And since then, price has been crushed. Okay, I've got my indicators, like I've got my big fib and my smaller fibs for the movement from yesterday with a nice cut on the 786. That's why I wanted to show it to you guys. But the biggest flex, I don't know if it's on SMP. I didn't trade SMP today. Well, I haven't traded in a long time actually. Trying to get the strategy going. But look, what was it? 20. Oh, so we only got today's. Well, you can see how basically, so we were maybe here, cleared up a quite bit of exposure, probably clearing some charm, so basically some time degradation. I'm just trying to check by volume. So by volume, yeah, so around 6450 you see you have a large put exposure that's putting you into a bad spot. So where was that? Yeah, it was right there. See how magic it is? a fucking drawn out resistance for me. Look, I'll put it at the exact price. So basically created that little wall for the rebound of the day. So you know this is not gonna be a resistance for next week or for like you don't really trade this, but you see how insightful it is when you combine it to other strats. And really the point is that this behavior is influential of almost $600 trillion in derivative. Um, the stocks themselves are worth a seventh of the derivatives market. Stock market is probably $150 trillion. Derivatives is nearing 600 trillion. So this delta hedging behavior is so impactful in the underlying price because the underlying is peanuts for them, and the overlaying has trillions, has billions of dollar every day that is backed up by it. Just look at it right now. This is a crazy number. And you know, I was chatting this guy who built this site, and he told me that the calculation is super easy. They just use the uh, either for volume or open interest. They use the value of this multiplied by the option value, the gamma value. So all of these are just single components that are found on, I don't know, whatever broker you use, and you add up these values and you get the interesting outlook on how derivatives are going to cost you, basically. How much is it going to cost you to hold this? And you know, I'm trying to get into Max Payne and the relationship with closing prices during expiration, because this is basically the logic. Max Payne, which is, you know, let me read it. It's the price at which calls and puts will expire with the least amount of money. So if you're a call writer, you're an option writer, this is ideal for you. If market could close at every time Max Payne price, you'd be literally printing money. Well, they already are, but you know, maybe a bit more. So yeah, that's it. Yeah, maybe I'll show you NVIDIA as well. You know, never never two without three. So I showed you a lamb, SPX, I'll show you NVIDIA. Yesterday was ER day. ER day. Big day for big year for NVIDIA. So ER day. Look at this. So always at 4:30, I think. Yeah, 4:15. So look, market was trending, then market went up. I guess when earnings released, or maybe went up before earnings, and earnings came, dumped, and since then, I made a post on Instagram. I was saying how price is gonna be ping pong, and that's kind of what happened. So even before earnings, got ping ponged a bit. Slash slash slash. Right now we're right here, but you see these little squares I made on my phone though, so they're not up to scale or anything, but it's just to show how basically price is being hedged right now in front of your eyes on Nvidia, and you can go check it. So look, what is the biggest walls where your delta derivative is gonna engage in a positive or negative acceleration for you? Look, 172.5. Beautiful, right? Beautiful. I'm kind of curious to look how long did it stay at that price, because yeah, not even I guess maybe 15 seconds, or maybe for 30 seconds. This is a 1 minute bar. Anyways, I mean, although this was this morning's open interest, you're holding this, okay? You're holding a call over or a put at for under 172.5. I don't even think um the option price has time to update, or I don't even think your commission fees are gonna help you profit. Option fees are actually pretty expensive. So yeah, you're basically raped if you have the 172 option expiring today. Yeah. And better believe this, it's not going to go under 172.5 today, the 29th, unless charm decay has engaged. Okay? Charm is the derivative of theta with the option price, and theta is the time decay of the option price. I'm just going to check right now what's the value. So 172.5 is right there. Okay. So you're basically losing 1 point. Oh, I forgot the definition. What was the definition? You're losing $1.84 per. So you are losing. The option price expected to decrease by $0.05 each day. So you're basically losing, at the moment, 1 point something dollar on your option per day. So considering the option is at $0.7, yeah, you're cooked. Okay, let's continue. You see, $1.175 positive gamma zone for callers, not callers, but call holders. Okay. You tried to long Nvidia earnings, right? 175. It's not a bad job, you know. So yesterday you were in profit the whole day till earnings, and it went up. So you might have closed it positive, but as we stated earlier, there is theta. Okay. And this was the JEX by open interest this morning. So, oh, you can see right now there is another huge gamma wall this morning. So I'm just gonna check by volume. So unfortunately, this was this morning, okay? So you see how the downside, the upside was basically cashed out yesterday, and everything that's left is the downside exposure. And you can see the upside exposure starts at 185, so that's why I drew this line at the beginning, just to show you that 185 resistance, which was present yesterday. But it's super interesting to see how this is directly caused by ping pong delta hedging behavior. You can see on the live right now, so I go back to the volume, so we have the live action. 175 is our resistance. So we could, you know what, could copy paste it. You could look at it yourself this afternoon, see if I'm right. 175. Let's see it. Good. See, so this is my new range, technically. Okay. Let's put a little emoji. The size of it. This is a bit unorthodox for me. I don't normally do this. This is my range. It's my little range. I'm bored, guys, sorry. Delta exposure by volume. So yeah, you see, so this is the residue that was, this is the chart that was updated at 9:45 this morning, and you can see a bit of residue from yesterday. So the 185, if I click on it, you see open interest this morning was, this is huge by the way. Open interest was 112K, but around 60K were traded today. So basically this morning it opened with this value. Today this was traded. I mean this option is fucking fucked. When did it drop? When was this? 4 p.m. That's so sad. You see, this is because of Theta and just the IV crush, you know? Your fucking option is technically doing okay, you know, because you're longing at 185, 175, and wait, which one was it? Oh, this was the 185. Yeah, okay. Yeah, 185 is just cooked. But if I go to the 175, because 175, those guys had a chance, you know. They could have done something. Let's check that price. So delta, gamma, there's IV crush. I'm pretty sure. Yeah. So this happens during earnings. Huge drop in IV because just simply no one's holding those options anymore because the news had happened. The reason they were holding it was to hedge themselves against the news. But once the news has happened and everyone knows what happened and the prices gets priced, the news gets priced in, you just don't hold it anymore. So everyone starts selling, and supply floods demand. And what do we get? Yep. What was that? 4 p.m. So I go back to what I was saying for the 185. These guys were doing well. You know, aftermarket, these guys were printing. But as I said, options are three-dimensional. So even though price is good, time. And, you know, I'm saying three-dimensional because there's the option price, there's the time decay, and there is the underlying price. But I shouldn't say option price as the first component. It should be IV. Instead of saying option price, I should say IV to really define what I'm saying about this tri-dimensional component in options. You see them right here. Delta and gamma is the same thing. So you see how time decay, option sensitivity to price, and supply and demand are three components defining the option price. And if one lacks, that's why 90% of options are worthless. If one is off, you could get crushed in the option price. So that's why I'm not putting option price as the one of the independent variables. Anyways, that was it. This is really my point about how gamma exposure is extremely important in trying to analyze day-to-day behavior, okay? Price behavior. Don't get me wrong. I'm not saying this is what rules the market. I'm not saying you use this technique and you could have known Nvidia was going to reach a $3 trillion market cap. No. Okay, this won't tell you what to buy as an investment decision. This will tell you why, for example, Nvidia is ping-ponged between a $10 collar, okay, when they've had okay earnings. I mean, hit or miss, depending on who's reading. Seriously. So, yeah, you see, I might be sniffing copium, but in the end, I have a pretty valid explanation for three stocks today that are moving in sequence with my data right here. This might be data porn, but I enjoy it. Okay, I enjoy it, And this is how I'm gonna roll today. I'm gonna build off these models. I'm gonna try to make basically utter learning behaviors on top of this, because I think this is a great way to measure the market's temperature. Okay, so that's it. I'm really happy to have found option charts, to have been able to talk to the founder who has really guided me through their JAX calculation, their the data they source, and it's quite amazing how in the end simple it is. You know, this is not you're not paying 30K a year for a Bloomberg terminal, you know, for some obnoxious or some shadowy ratios about interbanking loan in the sovereign Czech MMF market, okay? I'm not tracking foreign interest rate about a exotic currency. This is normal derivatives of option price and components, okay, of the option price, which already itself is IMO something amazing from a math POV. How one single equation like this can englobe so many components that are so important in defining risk and the value of risk. This is basically a dynamic Sharpe ratio. If don't quote me, okay? I'm just a beginner in this domain, okay? But I'm just I know I know a Sharpe ratio is kind of a factor for risk. Well, you got it right here. This is IV, dynamic IV right there, calculated on the live supercomputers. Okay? So yeah. Thank you for listening.